EPK Capital presents Deep Dive on Wells Fargo. For over 170 years, the Wells Fargo Stagecoach has been a powerful symbol of American commerce, a promise of security, reliability, and trust. But what happens when that trust is broken? For the past decade, one of America's largest banks has been on a turbulent journey, navigating the fallout from one of the biggest consumer banking scandals in modern history. Today, with a new CEO at the helm and the lifting of major regulatory punishments, the question for any investor is clear. Is the Stagecoach finally back on a smooth, profitable path, or are there still rough roads ahead? In this deep dive, we'll analyze Wells Fargo from every angle: its history, its financials, its scandals, and its future, to give you a complete picture of this financial giant at a critical crossroads. The company and its promoters, beyond the history books. To understand Wells Fargo today, we have to look back to its origins in 1852. Founded by Henry Wells and William George Fargo, the same minds behind American Express, the company was born to serve the booming California gold rush. It wasn't just a bank, it was an express company, handling the transport of gold, goods, and mail across the treacherous American West. Its iconic stagecoach empire and its operation of the legendary Pony Express cemented Wells Fargo's place in American history. By 1905, the company split its banking and express operations, with the bank remaining headquartered in San Francisco. From there, it grew into a modern financial powerhouse through a series of strategic mergers, including with the American Trust Company in 1960 and Minneapolis-based Norwest Corporation in 1998. But its most defining modern acquisition came during the depths of the 2008 financial crisis, when it purchased a struggling Wachovia National Bank, a move that massively expanded its footprint across the country. That history of growth has created a modern behemoth. Today, Wells Fargo is the fourth largest bank in the United States by total assets, holding approximately $1.9 trillion. It serves over 70 million customers across 35 countries through a workforce of more than 200,000 employees. The company makes money through four primary business segments. 1. Consumer banking and lending. This is the retail side most people know: checking and savings accounts, credit cards, and home loans. 2. Commercial banking, serving small to medium-sized businesses with loans, treasury management, and other financial services. 3. Corporate and investment banking, catering to large corporations with services like capital markets, advisory, and trading. 4. Wealth and investment management, providing asset management and financial planning for high-net-worth individuals and institutions. Even after strategically shrinking its massive mortgage division, it remains one of the largest retail mortgage originators in the United States. In October 2019, to steer the bank out of its crisis, the board brought in an outsider, Charlie Scharf. With a formidable resume that included CEO roles at Visa and BNY Mellon, as well as extensive leadership experience at JP Morgan Chase, Scharf was hired with a clear mandate: clean house, satisfy regulators, and begin the long process of restoring trust. His actions were swift and decisive, earning him the nickname Chainsaw Charlie within the company. He launched a massive cost-cutting initiative, aiming to slash billions in annual expenses by reducing management layers, closing branches, and cutting the bank's heavy reliance on expensive external consultants. He also strategically restructured the bank, splitting it from 3 to 5 distinct business lines to improve focus and accountability, while shedding non-core assets like the bank's student loan portfolio and asset management business to simplify operations. Most critically, he poured immense resources into overhauling the bank's risk and compliance infrastructure, the very functions that had failed so spectacularly during the scandals. The board has shown immense confidence in his leadership, recently announcing its intention to name him chairman and rewarding him with significant compensation packages for his role in the transformation. Unlike some companies led by visionary founders with massive personal stakes, Wells Fargo is overwhelmingly owned by large institutions. Around 79% of its shares are held by institutional investors, while insiders like the executive team own less than 1%. The top holders are the names you'd expect: the Vanguard Group, BlackRock, and Fidelity's FMR. This ownership structure is significant. It means the stock is a core holding in countless index funds and ETFs, making its performance sensitive to the decisions of large portfolio managers. It also means an investment in Wells Fargo is less a bet on a single individual and more a bet on the institution itself and its systemic importance to the U.S. financial system. A decade in the numbers. The Financial Health Report. Numbers don't lie. To understand where Wells Fargo might be going, we first need to see where it's been. We've compiled 10 years of key financial data, a period that captures the bank just before its crisis, the difficult years that followed, and the beginning of its turnaround. Let's break down the story these numbers tell. Revenue. Notice how revenue peaked around 2017 at over $88 billion and then began a steady decline. This reflects the direct impact of the scandals and the subsequent asset cap, which hamstrung the bank's ability to grow. In the last few years, we see a stabilization as the turnaround efforts take hold. Net income. This is the most dramatic part of the story. From a consistently profitable machine, generating over $20 billion a year, profits dipped in 2019 before collapsing to just $3.3 billion in 2020. That year represents the financial nadir, as the bank absorbed massive litigation costs and pandemic-related loan loss provisions. The strong rebound since 2021, with net income returning to the $19 billion range, shows the turnaround is having a real impact on the bottom line. Debt and equity. For a bank, debt is a bit different than for a typical company. What's important here is the trend. Under Scharf, long-term debt has been steadily reduced from a peak of over $246 billion in 2016 to around $173 billion in 2024, a clear sign of a deliberate strategy to de-risk and strengthen the balance sheet. Dividends. The dividend per share tells a story of confidence. After being slashed dramatically during the 2020 crisis, it has been steadily rebuilt year after year, signaling that management believes the worst is over and that profitability is sustainable. Taken together, this decade of data provides a perfect narrative arc. A stable giant from 2015 to 2017, the slow bleed from the scandal's fallout, a kitchen sink year in 2020 where everything went wrong, and a clear, deliberate, and financially successful turnaround from 2021 onward. The market's verdict, a technical look at the stock chart. Financials tell us about the company's health, but the stock chart tells us what the market thinks about its future. Looking at the long-term chart, we can see the full story play out. The stock hit its all-time highs above $65 per share in early 2018, right before the full weight of the scandals and regulatory actions began to crush sentiment. What followed was a painful, multi-year decline, culminating in the 2020 lows of around 22. From that bottom, the stock has been in a steady, if volatile, uptrend. It has spent years building a base and is now trading at multi-year highs, challenging the peaks of its post-scandal recovery. This puts the stock at a critical technical juncture. Let's identify some key levels to watch. Resistance. The ultimate long-term resistance is that pre-scandal, all-time high area around 66 SOPs. A sustained break above that level would be a powerful signal that the market believes the full recovery is complete. In the shorter term, the recent 52-week high around $84–85 is the level to watch. Support. Should the stock pull back, we can identify several areas of potential support. A major zone lies around the $50–54 level, which was the pre-pandemic price range. A more immediate floor can be seen in the low 70s, an area where the stock consolidated before its most recent leg up. To gauge the current momentum, we can look at the Relative Strength Index, or RSI. In simple terms, the RSI is a momentum gauge that runs from 0 to 100. A reading above 70 is often considered overbought, suggesting a stock might be due for a pause, while a reading below 30 is considered oversold. Currently, Wells Fargo's 14-day RSI is elevated, suggesting strong recent buying pressure, but also indicating that a short-term consolidation or pullback would be healthy. The chart tells the story of a classic fallen angel stock attempting a major comeback. After a brutal fall from grace, it has spent years rebuilding and is now knocking on the door of its former glory. The value investor's lens. Is WFC a Graham stock? How would the father of value investing, Benjamin Graham, view Wells Fargo today? Graham, who was Warren Buffett's mentor, focused on buying good companies at a fair price, always demanding a margin of safety. For conservative or defensive investors, Graham laid out several criteria in his book, The Intelligent Investor. Two of his most famous quantitative rules are: 1. A price to earnings, or PE, ratio no higher than 15. 2. A price to book, or PB, ratio no higher than 1.5. Let's run the numbers for Wells Fargo. Its current trailing 12-month PE ratio is around 14, which comfortably passes Graham's first test. Its price-to-book ratio is currently around 1.6, putting it just slightly above Graham's strict 1.5 threshold. To get a more holistic view, we can use the Graham number. This is a single formula that combines both earnings and book value to calculate a theoretical intrinsic value for a stock. The formula is Graham number 22.5x diluted EPS x book value per share. Plugging in the current numbers, using a trailing 12-month EPS of about $5.82, and a recent book value per share of about $50.21. With the stock currently trading in the low 80s, this calculation suggests that Wells Fargo is priced almost exactly at what a strict Graham disciple would consider its maximum fair value. It's not screamingly cheap, nor is it wildly expensive. The market appears to be pricing the company very efficiently according to this classic valuation framework. This implies that the investment case here isn't about buying a statistically cheap stock today, but rather about the potential for its earnings and book value to grow in the future, which would, in turn, raise its intrinsic value over time. The bull case versus the bear case. First, and most importantly, the asset cap is gone. In June 2025, the Federal Reserve finally lifted the $1.95 trillion asset cap it imposed 7 years ago. This is the single biggest bullish catalyst for the company. While competitors like JP Morgan Chase and Bank of America added trillions to their balance sheets, Wells Fargo was forced to stand still. Now, the bank is unshackled and can finally compete for new loans and deposits on a level playing field. Second, the sharp turnaround is delivering tangible results. The aggressive efficiency initiatives have worked, with over $10 billion in gross cost savings realized. This has made the bank a leaner, more profitable competitor, allowing it to reinvest in talent and technology while improving returns for shareholders. Third, the company is committed to massive capital returns to shareholders. With a strong balance sheet, the board has authorized a new, massive $40 billion stock buyback program. Since 2019, the company has already reduced its average number of shares outstanding by 22%, a move that directly boosts earnings per share for the remaining stockholders. Finally, the bank is making a strategic pivot to higher margin businesses. Under Scharf, Wells Fargo is deliberately de-emphasizing the more volatile mortgage origination business and focusing on growing its corporate and investment bank and wealth management divisions. These segments generate more stable, fee-based income, and early results show strong growth. On the other side of the coin, there are significant risks. First is the ghost of scandals past. The reputational damage was profound. The creation of millions of fake accounts, discriminatory mortgage practices, and wrongful auto repossessions have caused deep and lasting harm to the brand. A study from UC Davis even showed that the scandal directly drove mortgage borrowers to newer fintech lenders, suggesting a permanent erosion of trust that could take a generation to rebuild. Second, Wells Fargo is seen as a repeat offender in the eyes of regulators. The Consumer Financial Protection Bureau has used this exact label for the bank. It has faced a seemingly endless stream of multi-billion-dollar fines, including a staggering $3.7 billion penalty as recently as late 2022 for widespread mismanagement across multiple product lines. The risk of future regulatory actions and their associated costs remains elevated compared to its peers. Third, like all major banks, Wells Fargo's fortunes are tied to the health of the U.S. economy. A significant economic slowdown or recession would inevitably lead to lower demand for loans and higher credit losses from defaults, which would directly hit the bottom line. Finally, the competitive landscape is fierce. While the asset cap is gone, the bank lost 7 years of growth to its rivals. At the same time, the rise of agile fintech companies and digital-first banks continues to challenge the traditional branch-based model. Wells Fargo is investing heavily in technology, but in many ways, it is still playing catch-up. The entire investment thesis balances on this knife's edge. The bull case is a bet on future potential unlocked by the turnaround, while the bear case is a bet that the weight of its history will continue to be a drag on performance. Conclusion: investing in a work in progress. So, where does this leave us with Wells Fargo? Our analysis paints a picture of a company at a clear inflection point. On one hand, we have a financial titan that has survived a decade of self-inflicted wounds. Under CEO Charlie Scharf, it has undergone painful but necessary surgery, slashing costs, overhauling its risk controls, and finally, earning its release from the Fed's penalty box. On the other hand, the scars remain. The bank's reputation is still tarnished. It remains under the watchful eye of regulators, and it faces the same economic uncertainties as all of its peers. The bull case bets that the turnaround is real, and that newfound freedom will unlock years of pent-up growth. The bear case questions whether the culture has truly changed and fears that history could repeat itself. Ultimately, an investment in Wells Fargo today isn't an investment in the reliable old stagecoach of the past. It's an investment in a complex, ongoing turnaround story. A bet that the difficult work of the last 5 years has built a stronger foundation for the next 10. Please remember, this video is for educational and informational purposes only. It is not financial advice, and we are not financial advisors. The analysis presented is based on publicly available information that may change at any time. Investing in individual stocks carries significant risk, including the possible loss of principal. Before making any investment decisions, you should conduct your own thorough research and consider consulting with a qualified financial professional. And that's all we had for this video. If you found this video valuable, please hit the like button, subscribe to our channel, and let us know in the comments which company you'd like us to analyze next. Thanks for watching.